Hi, everybody. I wanted to do a quick video with our portfolio manager, Jeff Rivett, and introduce you to him quasi in person over the video here. Um, Now that your accounts are either moved over or in the process of being moved over, Jeff will now be sort of taking over the management of your investment accounts. So with that in mind, I thought it would be a good idea to just do a quick Q&A session with Jeff, and that way you could get a little bit of a better sense of what's going to be happening, what he's going to be doing with your money, the process, and who's behind making some of the decisions. So I thought I would start off by just having Jeff give you a little bit of an introduction to himself, and then we'll go from there.
Sure, thanks, Glenn. So I started in the investment industry August 11th, 2008, which was almost exactly 1 month before Lehman Brothers collapsed, which was a fun trial by fire to start off for sure. But it certainly taught me a lot, and it's been coming up on 17 years now that I've been managing money for and through. Certainly through COVID most recently, through the first U.S.-China trade war, through Brexit, through the European banking crisis. There's been a few moments of volatility over the last 17 years. So I've had the joy of navigating through those. I got my financial analyst designation in 2010, so coming up on 15 years with that. And like I said, about 17 years in this role. Most of the clients, the ones that are still with us, that I started with, are still here, and it's been a really fun run. So.
Okay. Yeah. Lots of ups and downs for sure. Maybe then we could talk a little bit about your investment philosophy that you have and how do you approach portfolio management.
Sure. Yeah, I think number one is I'm a very risk averse person. We manage a lot of money for a lot of people, and so I couldn't do that. I couldn't sleep at night if I didn't know that it was safe and that we were treating it like ours. So I would say number one, it's don't lose money. I always tell people. If your portfolio drops by 50%, you have to make 100% just to get back to even. Right. So let's not let that happen. And so we're always very cautious, and where we've tended to outperform in the past has been those periods of real high volatility when we've seen markets falling. We're always seemingly in a more positive position than most because we do a lot of work to prepare for those events before they happen. I'm a big believer in maximizing return and minimizing risk, which sounds obvious, but it's not always executed as best as it can be. And really, there's always risk that's out there, but sometimes there's opportunities that may be a little bit less risky because the prices have fallen so much, as an example, and so. Actually buying those when prices are down, you're in a situation where you have the potential to make a whole bunch more, so have a lot more return without actually having less risk. So, our goal is not necessarily to have the highest returns out there, but it's really to have excellent returns, but with much less risk than average.
Right.
So our portfolios tend to over a 10-year period. You may start here and you may end here, but the ride in between can be a wild. And I find that with humans, we're quite emotional, especially with our money. Yeah. And it's these ups and downs that can really cause people to make poor decisions and pull their money out. And so our number one goal is to make sure that you're comfortable, so that you're never worried. Or if you are worried, then you're reaching out to a team member that they can kind of walk through what we're doing. And but most importantly, it's just to keep you invested and make sure that ride's as smooth as possible. And that's really a big piece. I think that another one is that I'm a big believer that markets are human. It used to be that I used to say, well, it's about markets are about 50% technical and analysis and 50% emotional. I think that the more and more we go with social media and with everything now, it's getting to be more 60% emotional. COVID's a great example of that, where markets fell 30% during COVID, and in March,
like in a month.
In a month, exactly, like January 2020 and into February.
Yeah.
And the best time to buy was right at the right at the end of February in 2020, early March, and that was a time when we didn't have any vaccines, almost the entire world was shut down. It's a time of sheer panic, and so markets tend to overreact in both directions. They tend to overreact to the negative, as they did even in COVID. A 30% decline. I mean, that's trillions of dollars of value that was seemingly disappeared and became an opportunity. They can also overreact to the upside, and so our sort of main goal is to always make sure that we have, as markets are rising, we're building sort of that war chest of sort of safer assets that if things do turn, we can draw on and really take advantage of, and not necessarily time the market, but be more strategic with it. And then also, as the markets are falling, 10%, 20%, 30%, that's when we can start deploying that cash in. And what we found in COVID, as an example, certainly our portfolio drawdown was a lot less than average, about half of what the market was. But because we were buying on the way down, we were basically back to even in our portfolios by May of 2020. About 5-6 months before everybody else. So that process and that kind of smoothening, our clients have found have grown to love.
And I would say, getting back to your comment on investment behavior, that is the key determinant to a successful outcome, is what the investor does. So to your point of trying to smooth things out as much as possible, ultimately to keep your confidence at a level where you want to stay invested and continue to make investments into your portfolio through these what can be stressful periods of time. At least when you look at the headlines, that's going to be what really gets you to build up the necessary capital you're going to need to be able to achieve the goals that you've outlined to us as your financial advisors.
Yeah, I mean, there's a lot of financial advisors out there, and it's our job to keep our clients. And so we do that through building trust and delivering an investment product that hopefully doesn't surprise very often. It should be smooth and do what's expected of it, for sure. So
okay, great. So now, Jeff, you've seen some of the portfolios coming over from One Capital Management.
Yeah.
We've had some conversations around them. Very interesting.
Yeah.
I wanted to see if you could sort of make some general comments on what you're seeing, some of the changes you might be making going forward, and where there's some opportunities.
Yeah, I think there's lots of different ways to build a portfolio, and generally the outcome. I mean, it's most important is to be invested. I always say that be in the market, and so being invested is number one. There is one of the things. I'm a big believer in diversification. Our portfolios, we diversify across region, we diversify across currencies, we diversify into assets like gold bullion, and spread out our companies sort of globally as makes sense. And that's again that key piece to maximizing return for the lowest amount of risk. But there's also sometimes there's diversification for diversification's sake. And I find that quite often with sort of the more cookie cutter portfolios where it's like, hey, let's put a whole bunch of things in and sort of make it have all these pieces. And again, there's excellent investments that have done really, really well in your portfolios. And we're not going to come in and just start ripping everything apart all at once. But there's about 48 individual stocks in that portfolio. That's a lot. Warren Buffett says that once you get past 20, diversification starts to become less and less meaningful as you add more, and then once you get to 30 or more companies, the diversification benefit almost doesn't exist past 30. And so what you end up with is a portfolio when you're trying to track and keep track of who's coming and going, management strategy, quarterly earnings reports, company direction for 48 companies. It's really difficult to do well. And so our portfolios try to stay in that 20 to 30 sweet spot. So reducing some of those names is certainly something we'll be looking to do over time. And another area where we find is that there's a lot of different investment products out there, and some managers feel like, well, let's just own them all, which again, that's sort of diversification for diversification's sake. But there's some things in there like there's sort of what are known as high yield bonds or junk bonds or sort of these higher risk bonds, and there's not a huge portion of them. But we're in a period in the market right now where generally those are investments that we've certainly bought in the past, but we've bought them during bad times because they are correlated to equities, so they tend to fall when equities fall. And we're in a period now where, of course, equities are quite high. We're at record highs in the market. And so, you get a little bit more return than like a boring bank bond or a boring government bond, but you're taking on all that risk with the market. So that's an example of, where the risk and return don't really match up. So it's an area that's not a threat, but something certainly we'll be looking to ut back on. Similarly, there's some...
De-risk.
What's that, sorry?
Yeah, to de-risk the portfolio a little bit.
Yeah, exactly. Similarly, there's some investments in sort of futures and commodities,
right.
and again, great areas. But what I've found, because these typically are there's a lot of layers of management that are involved in these kind of products, and everyone wants a piece of it. So there's all these amazing strategies that happen, but the reality is that the returns just don't really exist for the client. I've seen that in your portfolios where there's some kind of dead money where it's providing some diversification, but it's not really doing anything. It's almost like having cash, and so it becomes a bit of a drag.
Yeah.
I think also another area, and again, being so heavily invested in the U.S. has been phenomenal. the last. Almost the last decade now. Right. But it's what happens with a portfolio like that, and it's a U.S. company, so understandably, that's where their comfort level is. Right. And the Canadian companies that they've chosen are actually all really good. But you end up giving up the tax benefits for non-registered accounts. Yep. By having not being able to take advantage of Canadian dividends. You have a whole bunch of currency risk, which has been a weight this year. Yeah. By having all the money in U.S. dollars, so bringing in more Canadian content both to the bond portfolio and to the equity side, I think also will be a big benefit. So we'll be again, it's not going to happen overnight. It'll be happening over the next while, but certainly some areas will be improving things.
So lots of work to do on that. Yeah. Okay, great. So I don't want to make this video too long. Yeah. Neither does Jeff. So we thought we'd just give you a quick snippet here, introduction, and one of the additional benefits that we've got now with joining the CRE team is Jeff works closely with the portfolio management team. Zach is going to be the fellow who's connecting with you on your portfolio on either a quarterly or semi-annual basis. He'll tailor it to how often you want to talk to him, and he's basically the conduit to discussions around the portfolio and what Jeff's doing. Jeff's really kind of doing, he's on his terminal, markets open to when they shut, and we let him concentrate on that so that he can do the best job possible for our clients, and then Zach or I are available to talk about the portfolio. So with that, I'll close her off. And awesome. Any party comments?
Nope, that's great.
It's Jeff's birthday today too, so we're honored to have him on his birthday.
And I will say I do put out a video every month as well, with just sort of market commentary. So you'll be seeing more of me through that as well, and I'm sure that'll be distributed. So yeah.
Okay, great.
Bud.
Thanks, Jeff.
Okay, take care.
Okay.
Yeah, thank you.